December 8th, 2025. The atmosphere in the financial markets is thick with tension. Silver is hovering ominously near $58 per ounce, scratching at the door of its all-time highs. But if you are merely looking at the price tag, you are missing the catastrophe unfolding in the shadows. While mainstream Western investors debate whether this is a temporary bubble or a soft landing, a much darker, calculated game is being played right beneath our feet, a game the establishment refuses to discuss openly. The superpowers of the East, specifically China and Russia, have stopped treating silver as a commodity to be traded for quarterly profits. They have rewritten the rules of engagement, repositioning their national reserve strategies to corner the market on this essential metal. If the pattern I have been tracking holds true, we are not witnessing a simple bull market. We are watching the terrifying early tremors of a global supply collapse that will leave the unprepared holding worthless paper promises. This is a tectonic structural shift where the world's second and 11th largest economies are systematically vacuuming up physical silver, while global inventories are bled dry by Western negligence. Let me tear down the curtain and show you exactly what is happening in the dark, why it matters for your survival, and what the cold, hard data screams about where this road ends. I am not a financial advisor. This is security analysis based on public information the elites would prefer you ignored. Let's strip away the noise and look at the raw reality. Silver closed 2024 up approximately 21%. But if you dig deeper into the geopolitical maneuvering, you find a signal that is far more significant. The Russian Federation made a calculated announcement in 2024 that fundamentally altered the chessboard. For the first time in over half a century, a major global power officially designated silver as a strategic reserve asset, moving it from the realm of industrial material directly into national security. The Russian Finance Ministry didn't just speak words. They allocated 51 billion rubles, approximately $535 million, specifically for the acquisition of precious metals between 2025 and 2027. We are talking about gold, yes, but also silver, platinum, and palladium. This marks a return to hard assets not seen since the crime of 1873, when Western central banks foolishly abandoned silver as a monetary reserve. For 170 years, the metal was relegated to the status of an industrial input, but never an official anchor of national wealth, until now. Russia just reversed a 170-year trend of demonetization. Why? Because Russia is signaling the end of the fiat experiment. They are telling the world that in an era of digital illusions and weaponized currencies, only physical atoms in a domestic vault constitute true sovereignty. China sits on roughly 70,000 metric tons of silver reserves, ranking third globally. But do not let that domestic supply lull you into a false sense of security. The story of China's consumption reveals a desperate hunger their own minds cannot satisfy. China produced 3,300 metric tons in 2024, but their insatiable industrial machine, the beast feeding their dominance in solar, EVs, and electronics, consumes oceans of metal far exceeding domestic output. China now manufactures over 80% of the world's solar panels. Crucially, the industry is transitioning from PERC cells to Topcon and HJT solar cells. Why does that matter? Because these newer, more efficient technologies require 20% to 50% more silver per panel. Without silver, the green revolution is dead on arrival. Furthermore, Chinese EV production surged 40% year over year, and every single EV rolling off those assembly lines devours roughly twice the amount of silver used in a combustion engine. Add the relentless 5G infrastructure build-out, and the math is undeniable. China must import staggering quantities to keep the lights on. But the real question is why now? Why is Russia, under heavy sanctions, allocating $500 million to silver? The answer emerges when you look at the collapsing supply side. The Silver Institute reported something critical in their 2025 World Silver Survey, a warning siren that went largely unheard. The global silver market is careening into its fifth consecutive year of a structural, mathematical deficit. Let me break this down. In 2024, total demand reached approximately 1.16 billion ounces, while total supply, mining plus recycling, only hit 1.01 billion. That created a physical deficit of 148.9 million ounces in a single year. From 2021 through 2024, the cumulative deficit reached a staggering 678 million ounces. That is equivalent to wiping out 10 full months of global mine supply, consumed and vanished forever into industrial products. 2025 is projected to be the fifth year of this relentless bleeding. The market is cannibalizing itself, consuming more silver than the earth yields. This difference is being drained from above-ground stockpiles, from legacy vaults that are now running on fumes. We are burning the furniture to heat the house, and the furniture is running out. The COMEX registered silver inventory, metal available for immediate delivery, tells a horror story. In February 2021, the COMEX held approximately 152 million ounces. By late 2024, that collapsed to roughly 73 million ounces, a decline of over 50%. The London Bullion Market Association, LBMA, echoes this emptiness. Their inventories fell to roughly 827 million ounces in December 2024, hovering near all-time lows. But the situation is even tighter because approximately 551 million ounces of that London total is allocated to ETF holdings. It belongs to investors, not the market. That leaves a paltry float of roughly 276 million ounces available for trade. Combine this with relentless industrial demand, which smashed records at 680.5 million ounces in 2024. This is not investment demand where the bar sits in a safe. This is silver being chemically consumed, destroyed, and locked away in solar panels, 5G towers, and AI data centers. Photovoltaic applications alone devoured 197.6 million ounces, nearly 30% of all industrial usage. With government mandates forcing solar installations to double, this demand is structural, permanent, and unavoidable. Here is where China and Russia act with a sinister difference. They are no longer passive consumers. They have become strategic accumulators. Russia's allocation of $535 million for precious metals is a calculated geopolitical weapon. Russia produces 28% of global platinum, yet they are still buying. Why? Two chilling reasons. First, sanctions. The freezing of $300 billion in Russian sovereign reserves taught Moscow that dollar reserves can be seized, but physical metal in domestic vaults cannot. Silver is the ultimate sanction-proof asset. It has no counterparty risk. Second, industrial strategy. Russia sees a future utterly dependent on silver for critical technologies, and they intend to hold the supply when the rest of the world runs empty. China's strategy is cloaked in silence, but is equally calculated. They do not announce purchases transparently, but import data screams the truth. While India historically imports record quantities, China's imports show consistent, methodical accumulation. Analysts note that from 2010 to 2022, China likely pursued a covert accumulation program similar to their gold strategy. We know China's official gold reserves reached 2,279 tons by late 2024 because they finally admitted it, but they had been buying secretly since 2015 via proxies. If China employed even a fraction of that discipline with silver, the amount taken off the market is staggering. Both nations are buying while prices are historically reasonable and physical supply is still technically available. History shows strategic reserve building happens before the crisis hits, not during the panic. They are building the ark before the rain starts. Gold provides the blueprint for what happens when powers accumulate resources. Central banks purchased over 1,000 tons of gold annually for 3 consecutive years, 2022 to 2024. The result? Gold launched from $2,000 to nearly $4,000. Persistent demand from entities with unlimited printing presses creates a structural floor under the price. Central banks do not panic sell. They vault and hold forever. Apply this logic to silver. Russia officially designates it a strategic reserve. China consumes more than it produces. Both compete for a shrinking pool of physical supply. Intelligence reports suggest Turkey, India, and Poland also increased precious metals reserves in 2024. The pattern is spreading like a contagion as dollar dominance erodes. Nations are hedging with physical assets in domestic vaults, diversifying away from paper promises that can be canceled by Western powers. This rush creates an acute problem for silver that does not exist for gold. Unlike gold, where production is steady, 70% of silver is a byproduct of mining copper, lead, and zinc. Silver's supply is inelastic. It does not respond to price. If copper prices don't justify a new mine, the silver byproduct never gets produced, regardless of silver's price. Base metal prices in 2024 were not strong enough to drive development, and primary silver mines are a dying breed. Primary supply fell to 227.5 million ounces in 2024. The easy, high-grade deposits are gone. Recycling faces hard limits due to thermodynamic entropy. Electronics recycling only recovers about 18% of the metal because it is used in microscopic amounts, and solar panels lock silver away for decades. Recycling added 193.9 million ounces in 2024, helpful, but nowhere near enough to close the 148 million ounce deficit. We are staring at a structural deficit for 5 years, record industrial demand, flatlining mine supply, and draining vaults. Throw in two superpowers systematically accumulating physical silver, and the result is brutal mathematics. When demand exceeds supply, one of three things occurs. First, price rises until demand is destroyed, but silver's unique conductivity makes substitution incredibly difficult, and green mandates make demand structural. Second, supply increases dramatically, but mines take 5 to 10 years to develop. This leaves the third option. Available inventory drains to zero. Physical shortages emerge. Premiums spike. The paper market diverges from physical reality. We saw this in 2020 when silver hit $28 on screen, but physical bars sold for $45. That was a temporary panic. Imagine when the shortage is structural. When deficit years stack up, COMEX registered inventory falls from 73 million to 50, then 30. At some point, physical supply becomes so tight the paper market loses credibility. This is why China and Russia's timing is clear. They are accumulating now, while metal is available and premiums are manageable. They are positioning before the crisis destroys the market. This is strategic reserve building 101. Accumulate in the shadows. Russia's public announcement of $535 million is a calculated warning. At current prices, that buys roughly 9 million ounces per year. It sounds small, but it is official and budgeted. China's scale is likely much larger. Regarding price, silver hitting $59 is approaching the inflation-adjusted high of 1980, $170 in today's money. But unlike the Hunt brothers, who were leveraged speculators, today's buyers are sovereign nations. You cannot margin call a country with nuclear weapons. Analyst projections range widely, but all point upward. Some suggest $75 to $90 by 2026. Others look at the gold-silver ratio. Historically around 15:1, it currently sits at 72:1. With gold near $4,200, if the ratio normalizes, silver mathematically reaches $280. If gold pushes toward $5,000, silver could target $150 to $200 purely on ratio reversion. This happens naturally when fundamentals align. But the real catalyst isn't ratios, it's physical shortage. When COMEX registered silver falls below 50 million ounces, the system faces existential stress. At current drain rates, that could happen within 6 to 12 months. When London vaults drain another 100 million ounces, market participants will question if there is enough metal to back paper claims. Recall the 2021 nickel squeeze, where prices spiked 250% in 2 days because a short position couldn't deliver. The exchange suspended trading and changed rules. Silver faces similar dynamics on a massive scale. COMEX open interest represents 226% of all vaulted silver. But looking at registered silver, the only metal actually available for delivery, the leverage is 18:1. That is 18 paper claims for every single registered ounce. The leverage is extreme. The system only works if everyone doesn't ask for delivery simultaneously. What happens when China or Russia decide they want physical delivery against futures? What happens when industrial users demand physical settlement to keep factories running? The strain would be immediate. Premiums would explode, and the disconnect between paper price and physical reality would become the only story that matters. The pieces are on the board: structural deficit, inventory drain, strategic accumulation, record demand, and stuck supply. The only question is timing. Major price moves happen when physical shortage becomes undeniable, when industry can't get metal and mints ration product. We are closer to that trigger than most realize. The December 2025 Fed meeting adds fuel. Rate cuts weaken the dollar, boosting hard assets. Geopolitics, U.S.-China tensions, sanctions, trade wars reinforce the lesson that paper reserves aren't safe. Physical assets in domestic vaults are the only real security. This explains the central bank gold buying spree and Russia's pivot to silver. It legitimizes silver as monetary metal. If Turkey, India, or Saudi Arabia follow suit, the impact on a market with only 1 billion ounces of annual supply will be dramatic. Gold has massive above-ground stocks, silver does not. Central banks buying even 50 million ounces annually would be significant relative to the tiny market size. Small amounts of capital moving into silver have an outsized price impact because the market is microscopic compared to gold or equities. If China and Russia are moving first, they are securing supply at prices that will look incredibly cheap in hindsight. What does $61 mean? It means we are in the zone where historical resistance crashes into structural deficit reality. If shortage becomes certain, repricing will be explosive. We saw it with copper and palladium. Now we see it with silver. Silver sits at the intersection of money and critical industrial material. You can't print it, and you can't substitute it. As China and Russia position strategically and inventories drain, the answer is frighteningly clear. There is not enough. This is not financial advice, but pattern recognition. History rhymes with every commodity shortage of the past 50 years. We are between denial and shortage. 5 years of deficit. Strategic positioning. Draining vaults. Everything points in one direction. The trajectory is up structurally, continuously, until supply increases or demand falls, neither of which is imminent. Understand the shift. The East is draining the West dry, and the window to act is closing.